Welcome, everybody. My name is Cédric Tille from the Graduate Institute, among the co-organizer of this series of events. I'd like to say a few words of welcome. Unfortunately, the director of the Institute, Professor Marie-Laure Salle, had another commitment, so she sends her regards and regrets that she couldn't come and attend. I would like to thank all the participants, the organization. We had a series of very good panels, and this would fit very well in that series. We thank the participants with very busy schedule for nonetheless finding the time to come and exchange with the discussion. This is a partnership between the Institute, the ICMB, and the Observatoire de la Finance, led by Paul Debinski, who's hosting this event. So it was very fruitful and motivating collaboration, which fits well with the Institute mandate to disseminate research and have critical series of discussion on the international financial system. International macro being one of the pillar of economics here at the Institute, alongside trade and development. So this set of discussion and reflections forthrighting, combining both historical angles as well as up-to-date macroeconomic questions. And I very look forward to this current panel here, where we'll be discussing the current situation and what next. So thanks for all participants in this panel and the previous ones. Beatrice, I give the floor over to you.
Thank you very much, Cédric, and thank you everybody for joining this fantastic fourth and last discussion and debate on the Bretton Woods 50 years on. And of course, we are finding ourselves in a situation in which the questions are much, much deeper, and the possibilities of scars in or new developments in the whole world order, including the international monetary order, are being asked. So the main purpose of this panel, however, is to discuss what has happened in a way since the demise of Bretton Woods, and why is it that we have one currency that appears to be very, very dominant. The title, The Inescapable Dollar, and in search for building blocks for monetary and financial governance. So we are both looking backwards and looking forwards. And I will be presenting the excellent panel that I have with us today in a moment, but I did want to show you something to sort of set the tone in terms of what I'm talking about here. We are talking about the question, where are we today compared to 50 years ago? And 50 years ago clearly is when the anchor currency was clearly the US dollar. You see here a map of the world, which is based on anchor currencies, which has not only pegs, but also includes the question, where do you have your debt? In what currency do you have your debt? In what currency do you have your trade? Clearly, red is quite dominant already, red being the dollar, and you could add to that some of the blue, because that is actually also linked to a European currency, and some of the green. But then we have the big de-anchoring, and the Nixon speech in Bretton, which ends the Bretton Woods system, is something that I actually always listen to at least once a year, because I use it with my students, in which we discuss the international monetary system and its crises, and crises of individual countries, and the US currency crisis that leads ultimately to the delinking from the US dollar is one of the most important and fascinating ones. Nixon ends the Bretton Woods in this speech, and it is worth watching again, because it always gets me every time when he talks about this little technicality, which is to de-link the dollar from gold. And that this would not have any repercussions, at least not for Americans, maybe for speculators and others around the world, but not for the US. So it is a fascinating moment. And where are we today is the question. And well, it stopped share. No, it's still sharing. So here is the answer from this same type of research, dollar dominance. You see the world has gotten much, much redder. And in particular, you have some of the big, in terms of geographical, but also in terms of weight in the world economy, joining the dollar dominance or dominated bloc. You have, of course, also clearly visible here the euro as the other essentially larger currency. So this is, as I said, one way of looking at what currencies are doing, what the international monetary system looks like today. Certainly not the only one. I'm sure we are going to be debating this. Is it inevitable? Is the dollar inevitable? Is it desirable? And going forward, is this the world that we are also looking into for the future, or is the present crisis so maybe a turning point for a different type of system? And what would this look like? I have with me a fantastic panel of experts on all of these questions, who not only have they made a mark in the, not only have they been long-term observers of the international monetary system, but they have also contributed both in terms of research and policy to its shaping. So let me start with Pierre-Olivier Gourinchas, who is just starting, moving in fact to Washington and starting as the director of research of the IMF. He will be on leave from the University of California, Berkeley, and on leave also from a few other places, but he still is staying with us as a fellow of the Center of Economic Policy Research, which I want to thank him for, and we are very happy to continue to benefit from his expertise. Then we have another long-time CEPR hero, I would almost say, Philip Lane, who joined the European Central Bank as a member of the executive board in 2019. He is responsible for the Director General of Economics and for General Monetary Policy, and he was previously the governor of the Central Bank of Ireland, apart from being a professor at Trinity and previously Columbia and Harvard. And finally, we do have Richard Kozul-Wright, the Director of the Globalization and Development Strategy Division at UNCTAD, a long-term sort of a important pillar of the United Nations, and both in New York and Geneva. And certainly when you look at some of his recent publications, among other things on Project Syndicate, you will see and expect him to have some views on the global inequality and how it has been progressing. Alexander Swoboda finally is going to give a few remarks at the end. Alexander is professor of international economics emeritus and former director of the Graduate Institute. And he basically, in many ways, is for a lot of people like us, was the Graduate Institute, is the place where people said, oh, that's where Alexander is. Okay, now I understand. Okay, so much for my introduction. I will now ask Pierre-Olivier will need to leave us a little bit earlier because he in fact needs to go to Washington. And therefore he gets the first place to give his introductory remarks in this first round. And if you want to share any slides, you are welcome to. Otherwise, this format has been quite interactive, and we have been seeing faces rather than slides most of the time. So Pierre-Olivier, the floor is yours.
Well, thank you very much, Beatrice. It's really a pleasure to see everyone today, and it's really a very impressive set of panels that have been organized, and I'm really glad to be part of one of them. And I would like to start with the question that Beatrice asked at the outset, which is the inescapable dollar, and are we living in a world where we will have dollar dominance? We do live in a world in which we have dollar dominance, but is that going to be continuing, and why do we live in such a world, since the system of fixed but adjustable rates that was in place during the Bretton Woods regime that had the dollar at its center has been left behind quite a long time ago now. And I would start by making 4 points in these opening remarks. The first one, to echo what Beatrice has said, is yes, the dominance of the dollar, in fact, by all the relevant metrics, has increased between, let's say, 1973 and 2022. Whether we look at trade invoicing, funding currency, holdings of reserves, anchoring, we have an increase in the dominance of the dollar, and a number of people have looked into that, and I think essentially the core mechanism that is behind this is really the process of trade and financial globalization. A global economy needs a medium of exchange, it needs a unit of account, and it needs a safe store of value. So it needs an international currency, maybe more than one, but it needs at least one. And in the if you sort of think about the world as it was in 1973 and where we are now, there's been a tremendous process of trade and financial globalization, and the dollar has been the international currency that has been undergirding that process. And as a side note, I will also point out that once you have sort of a dominant currency and other countries are anchoring their own currency to that, it can mask also the emergence of secondary reserve currencies. And for instance, in a world in which, let's say, China is anchoring its own currency to the RMB, then it may look as if the dollar is really or anchoring its own currency to the dollar, then it may look as if the dollar is really dominant, but maybe it's masking a shadow RMB reserve currency role that is sort of indirectly attributed to the dollar. But so we do live in this world. However, it will become an increasingly untenable position in the long run, and that's the second point I want to make. And the reason for this is that the US is already on its way to become a smaller part of a larger global economy. And so this is something that a number of people have studied in the past, starting with a report that Emmanuel Fari, Ellen Ray, and I wrote quite a while ago, but then others like Mauro and Barry Eichengreen or Matteo Maggiore have also weighed in, and this is sometimes called the new Triffin dilemma. It's this idea that if the safe asset that is provided to the world is backed by the fiscal capacity of just a single country, and that country becomes smaller, then at that point, maybe it becomes more difficult or even inconsistent with the stabilizing role that this asset is supposed to provide, and some transition to a new system should emerge. And I think that's, I would say, a consensus view that we will have to pivot to a more multipolar or more diversified world. Now, and this is my third point, there are two ways in which we can go about this. And one way in which we can go about this is that we try to manage this transition and we don't undo the process of globalization itself. We remain financially integrated on the real side, but we just have maybe more than one currency that is playing this dominant role. Alongside with the US dollar, we could imagine the two natural candidates would be the RMB and the euro. That transition could already be somewhat disorderly, because once you have competition between reserve currencies, then there could be large movements in currency values, or there could be large movements in capital flows. So that may need to be controlled, but it doesn't challenge the underlying world economic order that is being put in place. There is a second option, however, which I think up until maybe a month ago, fewer people were paying attention to, but I think it's been very present in discussions in the last 4 weeks. The second option, of course, is to deglobalize the world. In other words, to instead of trying to have multiple currencies cohabiting the world, to have different blocks, with each block having its own dominant currency, and the different blocks maybe not trading or interacting very much. And that's certainly one of the fears that has been raised by the conflict between Russia and Ukraine, the invasion of Ukraine by Russia, and the possible realignment of a number of countries away from this sort of multilateral agenda. And so here there is a real worry that we might undo some of the benefits of the world that we've created. In the process, it solves the Triffin dilemma, but it solves it sort of from the denominator instead of solving it from the numerator. And so the fourth point I want to make is that this is a sort of a call to arms. We have to find ways in which we can preserve the global economic order that we've implemented, with complex supply chains that allow countries to specialize along lines of comparative advantage, that allows financial flows to go to their most productive uses, and that increases efficiency and growth and standards of living around the world. And it means that the transition, to the extent we can, needs to be planned as much more forcefully than maybe we thought. So the attitude that we would just sit by and wait for maybe a competitor currency to emerge and then see how things work out, I think is a recipe for disaster. And here, let me outline just a couple of principles that we may want to have in mind when we want to think about what we're trying to achieve. I think the core issue is, how do we have a provision of safe asset that is sort of scalable with the global economy? The core of the Triffin dilemma is that if it's assessed on the single economy, it's unlikely to be scalable, especially if it's an advanced economy that is going to become smaller relative to the world economy. So somehow we need to have an elastic provision of a safe asset. It's hard to see how this can be done just by competition between currency blocks. And so it calls for more coordination and maybe some intermediation through an institution like the one I'm joining now, the International Monetary Fund. Now, I'm not sort of tooting the horn of the institution, but I think there's a need for a discussion along those lines. For instance, having the fund intermediating this provision of reserves, maybe backstopped by the treasuries and the major currencies in the world, would be a more efficient way, a more stable way, a more elastic way to provide a scalable global safety net. And I will stop here. I'm happy to discuss this in more detail in the Q&A. Thank you.
Great, thank you so much. You have put a lot on the table already, and I just want to already encourage participants who would like to ask questions to do so by typing them in the Q&A. And next, I want to call on Philip Lane for his introductory remark.
Okay, thank you, Beatrice, and it's a pleasure to join this conversation. And everything Pierre-Olivier said, I more or less also got in my notes. And it really is to go back to when we look at what's going on, it's important to differentiate the noise from the big trends. And the mega trend is a world where collectively the emerging economies, developing economies, just is taking a bigger and bigger share of world GDP, both through population dynamics and convergence. And so going back to my academic history with Jean-Marie Malaysia-Ferretti and then Jay Chambon, when we looked at currency exposures, it just screams out at you, this mismatch, that we have a dollarized financial system, also in pricing and so on, but trade patterns are not like that. I mean, China more or less trades as much with Europe as with the US, and having a currency that kind of okay, more and more flexible, but still more closely shadows the US dollar than trade-weighted exchange rate is a pretty basic issue. So let me use my kind of comparative advantage here to just make a couple of points about the escapable dollar as opposed to the inescapable dollar, because of course it's important not to overlook essentially the kind of solution found in the euro area. And just think about the counterfactual if the euro had not been created. And if we had, 19 extra currencies in Europe. I mean, the history of these currencies before the euro was there's definitely a kind of typically a management problem of trying to be somewhere in between the dollar and the Deutschmark. A lot of the history of the 70s and the 80s were basically the divergences within Europe created by dollar Deutschmark movements. And so in the sense that now we have a euro area, those 19 countries, which internally are basically euro denominated everything. And increasingly firms, definitely from the neighboring countries who sell into the euro area also price in euro. So when we definitely see that and there's a famous now joint data set between the IMF, the ECB, and some others, which show that. So we do have a regional currency. And by the way, the pandemic again reinforced the need for us to take into account spillbacks. So through swap and repo lines, where appropriate, is important. Not only for the US authorities to do it vis-a-vis the dollars, it is important for us to do it vis-a-vis euro. Maybe again, maybe it's a bit early yet, but I would say it's important to break up the 20 years of the euro probably into two phases. In the first decade, in the run of the global financial crisis, because essentially there were a lot of integration of the US and European banking system. Even with this single currency, there's a huge amount of dollar risk being taken in Europe, and we know during that crisis period there was a lot of international spillovers between the US and Europe. By the way, one of the paradoxes of that is when the euro dollar quickly became a pretty deep hedging market. And so smaller countries, which historically may have found it difficult to hedge dollar liabilities, could now borrow in dollars, hedge back into euro. So it is, the creation of the single currency also created more dollar trade. But post-crisis, there's been a pullback of European banks from international banking activity. There's a pullback in terms of bank-related debt from the US markets. And so we now probably have more of a zone of escapism from the dollar in the euro area than was true in the first decade. So I do think it doesn't necessarily carry too many lessons for the rest of the world. I mean, the circumstances where the European Union kind of formed this internal currency is not basically open to easy replication elsewhere in the world. And maybe in that sense, it's an interesting benchmark. What does it take to move away from dollar dominance? Is it the case? Or, you can pose that conjecture. Maybe China is so big that it can form it doesn't need coordination. It can just simply organize matters to become a dominant regional currency in Asia. But in general, probably by way of a contrast, it does suggest it's pretty hard to escape dollar dominance unless you're in the unique format of the euro area. So let me then come back to what Pierre-Olivier said at the end in terms of, and again here is about the kind of design of global safe assets. Mark Carney had a Jackson Hole speech, towards the end of his tenure, which was quite interesting on basically synthetic options there. Let me avoid some buzzwords that could come up. But let me stop there.
Oh no, don't. Okay, we'll get back to it. Okay, the next one on my list is Claudio Borio. Could you give your introductory remarks, please?
Thank you. I just unmuted myself. So I thought that I would take one of the many questions, and then I guess we can discuss the future of the dollar together in the Q&A. But the question that I'd like to address is whether the dominance of the US dollar is desirable. And in one important respect, and I think this was alluded to by Pierre-Olivier, obviously it is desirable in the sense that a globally accepted means of payment improves the efficiency of the global economy just as it does domestically. But leaving that aside, let me focus on the problems, then let me focus on one in particular. And the idea here is that the asymmetries, the general concern that the asymmetries involved deprive the system of an effective anchor of stability. And here there are a couple of different arguments. The first is variants of the Triffing dilemma. And the idea here is that contradictions that are inherent in the system condemn it to self-destruction. Now, the original one, of course, became moot once Bretton Woods collapsed and we adopted, and let me say in quotes, flexible exchange rates. But then it was superseded by what one might call a current account version of the Triffing dilemma. And that is that current account deficits are necessary to provide the rest of the world with liquidity. And if the US does, however, it is condemned to insolvency as a country, if you like. And then more recently, and I think Pierre-Olivier mentioned that, actually he focused his presentation on that, is the safe asset version. And the idea there is that the US government deficits are necessary to provide safe assets to the rest of the world. And if the United States does not do that, there is a recessionary bias in the sense that the US is unable to accommodate risk-averse behavior in the rest of the world. And on the other hand, if it doesn't do that, it eventually condemns the US government to becoming insolvent, or at least it raises the risk that that will happen. The variants of the exorbitant privilege, if we leave fairness aside, they basically say that the US is not a reliable anchor because the high demand for US denominated debt means that it is not subject to sufficient discipline, which ultimately spreads instability to the rest of the system. Now, my interpretation is that these arguments, of course, carry some weight, but they don't have as much force as is often argued. And they probably miss what I think is the key mechanism through which dollar dominance has failed to provide a strong anchor of stability to the system. So let me take them in turn. First of all, the exorbitant privilege, if you like. Well, I don't think that that's at the root of the problem, and I will elaborate on that further later on. But moreover, in a world of free capital flows, I think the size of this privilege can easily be overestimated, because there are many countries that can borrow in spades and heavily in domestic currency. Even, for example, a country like Australia that has had multi-decade continuous current account deficits. Now, the second version, the current account version of the Triffing dilemma is obviously wrong. And I think it has become better understood. US dollar liquidity can be produced at will, regardless of the current account position. It can be produced by the US by simply increasing its gross assets and liabilities like any bank would. And here, Kindleberger and Salant, I think they really got it right. And Alex, you also pointed this out some time ago, but sometimes it's just forgotten. And of course, and this is just as important, they can be created by the rest of the world. I mean, US dollar claims entirely, that is, US dollar claims entirely outside the United States. Probably what people don't focus on is that 3/4 of the overall debt of non-banks outside the United States is held by non-US bank residents. So this is completely offshore, dollars created offshore with no reference to the United States as such. Now, the safe asset version clearly points to a valid tension, but my sense is that it probably goes too far, because at least one reason is that it suggests that the system has a contractionary bias, a structural contractionary bias. But in fact, I would argue that the system, as we have seen it so far, has had an expansionary bias, not a contractionary bias, and that the dominance of the dollar can amplify that. What I mean by an expansionary bias, what I mean is that since financial liberalization, the international monetary and financial system exhibits what I would call excess elasticity. That is, the inability to prevent the buildup of hugely damaging domestic financial booms and busts, or what one could call outside financial cycles, on the back of strongly pro-cyclical capital flows. And these tend to generate recessions and financial crises. So you have an expansionary bias in the short term, but actually leads to a contraction longer term. So by financial cycle, I mean typically unsustainable domestic credit and asset price booms, which, and particularly property prices, by the way, which overstretch balance sheets. And here you have a kind of self-reinforcing interaction between this domestic financial cycle, which has been at the core of recessions, and the global financial cycle, if you like, that Ellen Ray has talked about, or more generally, I would say, global financial conditions. And the key point here, which is not often realized, is that since the mid-1980s, we have seen a major change in the nature of the business cycle, from what I would call inflation-induced to financial cycle-induced recessions. Until the mid-1980s, and leaving aside the current episode, which we can come back to, recessions were caused by a rise in inflation, which caused central banks to tighten, and which in turn triggered the recession, but very little actually happened, if you like, to financial cycle indicators. Since then, as we know, inflation has been stable, so there has been no need for central banks to tighten, but big financial expansions led to contractions, to these financial recessions. And of course, the great financial crisis is the biggest example of that. Now, how can the dollar amplify this? Well, the dominant currency has a disproportionate role in spreading instability. It does this directly through the direct influence on financial conditions elsewhere, and it does it indirectly, and just as importantly, because of the rest of the world tendency to avoid exchange rate appreciation. Because there the choice is between either reducing interest rates, but then that basically can fuel the domestic imbalances that I mentioned earlier, or try to resist it, intervening, at least for a while, and that will in turn then put downward pressure on the yields in the core country, in particular in the United States. Now, please note that this is not out of precautionary motive. It's not that you're trying to build up reserves independently, but rather as a byproduct of trying to resist appreciation, whether because of competitiveness reasons, or indeed when we're having inflation targets and we're undershot, simply trying to get a little bit closer to your inflation target. But of course, there has been a precautionary motive. I think it was very right and center following the Asian financial crisis in particular. But over time, I think this, if you like, byproduct type of accumulation of foreign exchange reserves, I think has become more important. Finally, what happens when prevention fails? And as I think you've realized, I think that it has failed big time over a number of business and financial cycles. Well, of course, and I think as Pierre-Olivier mentioned, it's important for the US to play the benevolent hegemon role that Kindleberger liked to emphasize. And by that, we mean international lender of last resort. And I think we should recognize that the US has done so to an increasing extent. Did so after the great financial crisis, and even further during the COVID crisis, particularly by establishing these central bank FX swap networks. But of course, there are clear economic and political limits to this kind of or if you like, enlightened self-interest. And this does call for complementary sources of international liquidity, and probably we don't have enough of that. And finally, just one point, which I think emphasizes what Pierre-Olivier mentioned before. Would a more symmetric system address this problem, the one that I highlighted? Well, it's not at all obvious, because at the end of the day, the source of the problem are inadequate domestic policies. And of course, the core country, as being the conductor of the orchestra, has a big impact on the rest of the world. And competing currencies could definitely alter the dynamics here, but in fact, in some respects, could actually make matters worse. So let me stop here.
Thank you very much, Claudio. I now give the floor to Richard.
Thank you, Beatrice. You've left me in a fairly difficult position coming after the three previous speakers who I think have covered a huge amount of ground. Let me try and add something, and I think I will particularly follow on from what Claudio says about the instability of the system, because at least from where we're sitting, developing countries tend to be the victims of that unstable system. Just in terms of the general setting of what has been said, I guess we feel in the work that we do that whilst the dollar-based system is certainly under pressure right now from the forces that people have discussed, and arguably, I guess the issue around sanctions and to some extent the weaponization of finance has added another dimension to that discussion, and certainly a number of significant developing countries, I think, will be looking at that question more intently once the horrors of the war have ended. But I guess we tend, and also another point I think in that context, you know, I'm not comfortable with the notion of a multipolar world, I guess. I mean, China has risen tremendously over the course of the last 2 decades, but I don't think it's true, despite all the talk about the BRICS and other sources of dynamism in the global economy, that other parts of the emerging world have not been able to replicate the Chinese experience. And I think the use of the term multipolar world is a little bit misleading. And in that context, at least, I probably agree with Pierre-Olivier that these pressures are shifting us away from a dollar-based system, the ones that he outlined, but it could take a long time, I think, and that leaves us with the kind of system that we have and the kind of system that I think Claudio described, which is a highly unstable system, and it's a particularly unstable system for many developing countries. The pro-cyclical nature of global finance has already been referenced. The crises that have hit developing countries over the course of the last 2 decades follow a pretty familiar pattern in which the activities of the leading central banks have played an instrumental role in terms of provoking crises, and we're seeing it again now. Most of our constituency right now are extremely worried about the pace at which the Federal Reserve will be raising its interest rates. Most emerging economies, I agree to some extent with Claudio that a lot of advanced economies can clearly still borrow in their own currencies. That's not true, of course, of most developing countries. They have to borrow in dollars, and in a world of rising interest rates, of a strengthening dollar, the pressures on repayment are becoming extremely intense. And in that world, the Federal Reserve is clearly not a global lender of last resort. The use of swap lines has been a very important addition, I think, to the global financial safety net. That's true. But the number of emerging economies that have been privileged by that access is very small. Most of it has gone to other central banks in the advanced economies, and clearly it doesn't provide the kind of support that countries that come under extreme financial pressure require to be able to stabilize their economies. I do think that many developing countries, perhaps more than Claudio suggests, have accumulated reserves for precautionary reasons. They are costly for developing countries. The cost of reserve accumulation is very high, and that again adds to the pressure that they face. And I guess in that context, I'm not expecting a fundamental shift in the dollar-based financial system. I guess the issue that we ask and much of our constituency asks is, well, what can be done to provide a greater degree of stability for developing countries? And you know, of course, I guess the issues that we will subsequently talk about the role of special drawing rights as being a more effective source of liquidity provisioning for developing countries, I think needs to be discussed. I think we all appreciate the recent initiatives. We're also fully aware of their limitations in terms of the way in which special drawing rights are allocated based on the existing quota system. I think we do need to look a little bit harder at some of the regional mechanisms that have emerged in recent years, not particularly effective in terms of scale, but suggest a change of direction. Chiang Mai, swap lines amongst the BRICS countries, initiatives in Latin America, etc. And I think the question of stronger regulations does need to be issued. And I think finally, in this kind of dollarized world that we think will persist for some time, there is the whole question of the governance of the international financial system and the privilege that the rules of the game that were set 75 years ago continue to give to leading economies in terms of their ability to orchestrate the system. It continues, and for many developing countries is a constant source of frustration and irritation, and I think needs to be discussed in terms of trying to find a more balanced way of dealing with the highly financialized system that developing countries find themselves in. Thanks, Beatrice. I'll leave it there.
Thank you very much, Richard. Reminder to all participants, if they want to ask questions, your chance is now. Send in your Q&As into the Q&A. Because otherwise, you know, I will be discussing with my friends the things that I am interested in, or they are. So in this second round, actually, since Pierre-Olivier, you will need to leave us, I think I wanted to give you the chance to react to the other interventions first. Also, you did, you know, get some, I would say, pushback from Claudio in terms of, you know, the view on the Griffin dilemma. Is it contractionary or actually expansionary? And the second point was in the Q&A, specifically to you, the question whether you think that a reformed SDR could provide this safe asset by treasuries of the world that you were calling for. And last but not least, another question to you, how about the RMB? Can it really be up to this task, even as a secondary reserve currency, as long as its capital account is still not fully open? So Pierre-Olivier, you are on.
Yes, well, thank you, Beatrice. Just let me start from the end and just address the two questions in the Q&A. Obviously, the RMB is not anywhere near a position where it could become a challenging international reserve currency, precisely for the reason that's mentioned, which is that there are still lots of strings attached to financial flows between China and the rest of the world. And one of the key conditions for an international currency is that somehow you can hold it. I mean, the point that Claudio was making, that a lot of the dollars are offshore, is well taken, but there needs to be some onshore offshore transactions are possible and fairly easy. Otherwise, it really can't establish itself. So we're certainly not anywhere near the time where a transition like this would happen. SDRs is always something that comes back, and in a sense, this is sort of the and here I'm going to highlight the fact that I'm speaking in my own capacity and not in the capacity of the institution I represent. But there's a little bit of the lamppost a problem with the SDR. So this is where the light is. So we look for our keys. The SDR is an instrument that has a number of defects in the way it can provide liquidity. I mean, it's not that it can be used, and it can be useful in some circumstances. The fund actually did a $650 billion increase in SDR just last year, and it certainly has provided liquidity to a number of countries. But we all know about the problems with it in terms of the allocation, in terms of the mechanism for trading it, etc. So it's not really a panacea by far. But let me get to the broader point. I think Claudio really highlighted something that is incredibly important, and I left out in my remarks, not because I disagree with it, but because there's only so much I can pack in 5 minutes. And this notion that financial globalization can run ahead of us in a sense, and in a world in which you have a center currency like the US dollar, and you build this financial architecture on this the dollar as an international currency, you can get in a situation where you get amplification of, for instance, monetary policy impulses from the US to the rest of the world. That's sort of one of the key feature of the global financial cycle that Ellen Ray has described. You can get all kinds of amplification, distortions. Emerging countries can be on the receiving end of this whenever the Fed starts tapering or pivoting in terms of its financial cycle. Either there is a wall of capital that moves out of emerging market economies, or it moves into emerging market economies and are just on the receiving end. They've asked for nothing, and yet here they are, and have to manage this in an environment where their instruments may not be quite as effective and their markets not nearly as deep so that they could absorb such huge movements. And so there is all this additional layer of potential amplification, some of it related to imperfect regulation of financial markets or not taking into account the spillovers. And I broadly, fully agree with this. So I don't think I necessarily want to get into a expansionary versus contractionary view of the Triffin dilemma. I mean, I think the broader view is, at the end of the day, even if you have this financial cycle and then it implodes like it did in 2008, and a country like the US is sort of asked to step in and expand its provision of dollar assets to the rest of the world in the form of swap lines and other instruments. At the end of the day, you still have this function of sort of insurance and provision of liquidity that is very important, and that increasingly, as Phil Lane has mentioned, is going to be out of line with the size of the U.S. economy in the world, and so that's sort of the core. That's the core issue, and I in a sense, I think we could take a view that it's a question of regulation. Let's put in place the right regulation, domestic regulation, maybe some coordination of the international financial system in terms of having counterparty measures and things like that. And of course, Claudio is sitting at the sort of the center of very active thinking about and policy making in terms of this. And this is absolutely critical. And even if we are in the world in which we could deal with the financial cycles, then do we solve the problem? My answer would be not quite, although it would already be a much better world than the one we're living in. As an aside, let me point out, and of course, events could change very, very quickly, but there's been something quite remarkable that's been happening in the last 3 months. I mean, if you think about the pivot that the Federal Reserve has done, between December and March, in terms of what it has been telegraphing to the rest of the world it would be doing in terms of monetary policy. Back in December, we were looking at something that was on the order of 3 interest rate hikes in the course of 2022. Now we are looking at something that is between, let's say, 7 and 9. It's a very, very massive change. Now, there has been some repricing in the market. There has been some adjustment in exchange rates. But we haven't seen any of the dislocation and collapse in emerging market economies that we used to see in prior episodes, like the taper tantrum in the 2010s. So I think here, countries have already tried to take on board a lot of the things that maybe Claudio has mentioned in terms of deploying instruments, whether it's reserve accumulation, whether it's implementation of capital flow management, whether it's sort of better prudential measures, and more generally, I think we, and of course, I want to say this with the proper caveats, things could change, maybe in a week, things will be completely different. But so far, there's been a major repricing of interest rates, US interest rates, without a major dislocation on emerging markets. And I think that should be noted. I'll stop here.
Thank you very much. Can I add one? I mean, this is in fact very remarkable what you're just saying. But the level of debt and debt vulnerability in many countries remains high, or in fact, may become more striking now. You think we can get through it?
I honestly, I think the debt levels have increased. Debt service in emerging market and low-income countries has not declined despite the low interest rate, has stayed constant or even increased. So we certainly, one would certainly be worried in the current environment, increase in energy prices, increase in food price for many low-income countries. These are going to have major effects. Countries may try to support their population with food subsidies, energy subsidies. There is a fiscal cost of all of this. So you put all of these things together, you would expect major pressure on sovereign debt markets. There's been countries like Nigeria that are borrowing 200 basis points above what they were borrowing maybe a month ago. So there's certainly been some impact, but markets are open and countries are not yet cut off from access to funding. And this has been an interest. And by one last data point, if you want, we do have, and that's another thing that we do have major capital outflows from emerging market economies over the last month, but it seems to be concentrated mostly on China and could be related to what's happening with lockdowns and Omicron in China more than the broader geopolitical environment or other things.
Okay, thank you so much, Pierre-Olivier. Now, can I move in the same direction as before? Phil, do you want to comment on anything that you heard or anything you would like to add?
Okay. So let me make a few points here. One is, I suppose not just this panel today, but the whole discussion, I suppose it probably might want to do a better job of differentiating. Let's find the first best. Let's find the perfect solution, and say, well, and we should of course always try and articulate and work that one out. Versus what is the minimum, and what can we live with? And I would also advocate here that it's important, I think, for everyone to update their priors and understanding. Not every second, but maybe decade by decade. And I do think if you think about the last number of years, the last half dozen years, and if just think about the last couple of years, some of the other elements here to think about in terms of risk management are, asset purchasing by central banks, in the advanced economies, because we know, we show all the time from the ECB that there's when the ECB buys more, domestic assets, essentially, it has major implications for international portfolio flows. That's a pretty big issue, which was not there before when we just had interest rates moving around. So that basic about the connection, and we know in this particular crisis in the pandemic, at least some emerging markets were also able to stabilize their domestic currency debt market through purchasing. So this goes back to kind of, it might be second best, but the fact that by and large, more and more countries are long foreign currency, very expensive, as Richard said, very suboptimal collectively, but individually, the fact that, reserves have been built up, sovereign wealth funds exist and so on, has created in some more options from a policy point of view, even if it's collectively inferior to a global safety net. But maybe I'll raise here, we're here talking about countries. There's also the issue, which I think has been a feature of the literature in the last number of years, about private sector versus government, and some possible perversions here, where the more the government tries to create safety, the more foreign currency risk is taken on by the private sector. And we see that in various cases. So I suppose all I'm saying there is that there's a huge set of interconnected issues here, which maybe we should spend more time on, absolutely. So there's a lot of work to absorb, understand the global financial crisis, understand the immediate aftermath, fully drawing the lessons of the last several years, maybe, at least from my point of view, remains incomplete.
Thank you. That's probably nobody would dispute that we don't have enough understanding. But I also hear from at least, probably all four of you, sort of a little bit of an age of diminished expectations. It's not so bad after all, so let's and we don't have huge ambitions for really big changes. So it is up to the countries to do their homework, as Wolfgang Schäuble used to do. I may be misrepresenting your views, Claudio. The floor is yours anyway.
By the way, can you see me? Because I cannot see anyone now. It's completely good.
Yes, we can see you. We can see you.
Okay.
Right.
What I will do afterwards is switch to the iPad, but not to create problems. Well, yes and no. I definitely think that, the getting your own house in order is a necessary condition for all this. And of course, those countries that have a bigger role, bigger impact on the overall system are particularly important, and not everyone is born equal. But of course, there is, you can think of, and again, I mean, the reason is very obvious, right? I mean, if you think of the envelope theorem of welfare economics, if everyone is maximizing already or optimizing already, the amount that you can gain through cooperation beyond that is more limited. But of course, I think that there are things that one can do. I think enlightened self-interest, as I mentioned before, is important. And again, I don't want to talk about institutions like ours or indeed the IMF, but the ability of countries to talk to each other, I think it's an important element in all this. Can we go beyond this? Can we establish new rules of the game? I'm rather skeptical about this. But let me say again, and this is consistent with what Pierre-Olivier mentioned before, that countries have already done quite a bit in order to improve their ability to withstand, if you like, these global forces. And as Pierre-Olivier said, emerging market economies are better placed than they used to be. And one way in which a number of them have done this is by relying precisely on a combination of foreign exchange reserve management, on at times and the extreme capital controls, particularly for inflows. But beyond that, I think prudential regulation, both in terms of microprudential regulation and macroprudential regulation. I think the next step would be to do this in a more coordinated and coherent, consistent way. Things that we have been arguing at the BIS for a long time in the form of what we call a macro-financial stability framework. And the IMF has actually been talking about in terms of the integrated policy framework. And here FX intervention actually plays an important role. And it's basically a quasi macroprudential role, if you like. On the one hand, it improves the resilience if things turn bad. And on the other hand, by simply accumulating reserves as financial imbalances build up, you can actually restrain them a little bit like what you do with counter-cyclical capital requirements. But there are clearly limits to that. It is indeed true that for the first time, actually, during the COVID crisis, emerging market economies could act counter-cyclically, which they had not been able to do before to any significant extent. That speaks to the improvement in their frameworks. That speaks also, however, to the fact that global conditions remained very, very loose as a result of advanced economies also responding in a similar way, because everyone was in the same boat. So far, as Pierre-Olivier mentioned, it's indeed the case that emerging market economies have weathered very well the pivot of the Fed. They have weathered it well, but I think I would be more cautious and think that everything is fine for a couple of reasons. First of all, because these countries have less room for policy maneuver than others do. And in fact, debt levels, as was mentioned before, and in fact, de la Rosière mentioned this in the first panel, I think, of this series. Debt levels, both public and private, are historical highs. And the only reason why they have been, countries have been able to sustain them, but by the way, advanced and emerging market economies, is because interest rates have been extraordinarily low. But that is in the process of changing. The other reason is that, in fact, although we have seen a pivot, global financial conditions have not tightened. And indeed, the dollar has not appreciated much. And that, I think, has partly been because of the idea that these interest rate increases are going to be pretty gradual. But if that turns out not to be the case, and if inflation proves to be more persistent and uncomfortably high than we're thinking now, then things could change, and emerging market economies would be the first in the line.
All right, thank you very much, Claudio.
I think I think I would be slightly more nervous than Pierre-Olivier, certainly in terms of emerging economies. It's true that a number have dodged a bullet after COVID-19, when the initial shock looked like it could trigger very serious deflationary spirals in many parts of the developing world, and it didn't happen. I mean, one of the reasons it didn't happen, but I think, was that commodity prices recovered surprisingly quickly and have been rising strongly for the last 8 or 9 months, and particularly sharply now. And you know, the region that benefits from that always, of course, is Latin America, which is one that you always look to as a canary in the deflationary coal mine. And it hasn't happened. And I think commodity prices have played a particularly important part in that story. Of course, for other developing countries that are heavy food and fuel importers, the pressures are increasing considerably, particularly in some countries in sub-Saharan Africa. We've seen that in Ghana already, and you know, a country like Sri Lanka is essentially de facto in default. I think the danger in developing countries is perhaps more serious than might have been suggested, and I don't think a lot of them have the kind of support that they will need to get through this. And that's what at a time where political sensitivities are also rising. We see that with food prices and the political consequences of that in a number of emerging economies. I think we should be more worried than perhaps we are about the prospects for some of these parts of the developing world over the next 6 to 12 months.
Can I just add to that statement a question? So if you are more worried, you know, about possible debt crisis, how do you see the present comprehensive framework for dealing with those going forward? Is it it's untested so far? It includes China. What is your thought?
I think there are only 3 countries, right, that are actually under that rubric at the moment. I don't think we know. I mean, our argument has been, you know, coming out of what we consider to have been the rather welcome but ultimately fairly pitiful response of the debt service suspension initiative, which has accounted for what, $12 billion, and has now come to an end. The countries have accumulated multiples of that in terms of new debt as a consequence of having to respond to the COVID shock. These numbers, for most developing countries, don't add up. The common framework, as you said, Beatrice, is yet to be tested. But I guess we think that probably a second opinion is in order when it comes to the debt challenge that these countries are facing.
So we have somebody an anonymous attendee asked a question that is on all our minds. What will the current Russian sanctions do to the international reserve currencies? That seems like a more short term, but also what is your view? Are we at a pivotal moment in terms of the international monetary order? And what could that look like? So I see Claudio smiling, which gives you the floor.
I'm smiling. Can you hear me? First of all, I switched.
Yes, we can see you and hear you.
Okay. No, actually, my view on this, and again, it's a personal view, don't take it as an institutional view because we are very much speculating here. It's similar to Pierre-Olivier's. I think that if you look, first of all, the point to remember that we have always had international currencies, and they have always been the extension of powerful states, powerful countries, politically, economically, and financially. From Byzantium solidus to the US dollar. I mean, you can look at the history of currencies in the world, the Muslim dinar, and so on. They have always been if you like, the extension of a powerful state. But they have all come and gone. The question is how long it would take, given that for all the reasons that we mentioned before, they're very strong network effects, they're very strong, there's a lot of inertia in the system. And if you look around, it's not obvious that they are, as of now, and I would say for the foreseeable future, unless there are some kind of catastrophic events, clear rivals to the dollar. The euro, we know, it's not, if you like, up to the task, given that, yes, it has large capital markets. Yes, it's a big country in the world in terms of real economic activity, but it lacks political unity. Still depends on the US militarily. It lacks sufficient deep unified markets, and it remains economically vulnerable because of this lack of unity and the multiplicity of sovereign states. The renminbi, well, it fulfills the economic and political requirements, no question, and it has taken the right number of steps. For example, encouraging the invoicing in renminbi. I mean, if you look historically, invoicing is always the first step, because then you have to hedge your revenues, and you do that by borrowing in the same currency. And it is has proved willing to, at least rhetorically, to provide renminbi liquidity, although it has not yet have to do that. But for the reasons that were mentioned before, it doesn't have deep and open financial markets, and the rule of law raises questions. Again, so over the long run, is it possible to conceive of a world of two blocks, if you like, one which is dominated by China and the other which is dominated still by the United States, which is, of course, would be a deglobalized world? I think it's conceivable. Would that happen? I don't know. I don't have a crystal ball. It is something that it's worth considering. But beyond that, I think that beyond going to that world, I think that globalization is already sort of in retreat. And that I think it would be important for us to, for a number of reasons and in a number of ways. And I think it would be incumbent on us to think of, first of all, the loss in terms of global growth and GDP. And secondly, too, of what the implications of that are more generally for the dynamics of the economy, even at business cycle frequencies and for inflation.
Thank you, Claudio. So Phil, that was a direct challenge to the euro. It's not up to the task, is what Claudio said, but it's also true that for a long time, the international role of the euro was not at all a goal. It has more recently become both, I think, in the economic and political sphere, something that is seen as desirable. Can you comment on that?
Well, I think there's several levels. First of all, I mean, it's pretty clear that the more the euro area domestic architecture is developed, hand in hand with that, the more attractive will be the euro as an international currency. So at that level, it just reinforces the impetus to make progress on all dimensions of having a more unified euro area. Then, as I was mentioned earlier on, I mean, it does connect very much to the strategic autonomy, mindset, if you like, that essentially would be a bit strange for a continental sized European Union to basically be so outsourcing so much, if you like, to the US dollar in terms of how the international system operates. So at that level, I mean, at a regional level, as I mentioned in my opening remarks, there's a lot of Euroization of trade with the. So from our point of view, there's a lot of insulation from the dollar in that sense. But hand in hand with that, we also have to think about Europe as part of the global system, and also going back to what I said at the start, that essentially going back to swaps and repos and so on. I mean, that's not everything, but it's one dimension. To be clear, that we do recognize that if you are going to have an international role, if other countries are going to rely on euro funding, you do have to step up in terms of being under the appropriate limitations, a source of liquidity in a distressed situation. So, I think, and also, by the way, it pretty basically turns as well on conditions in different monetary systems. So we've had this big common cycle where interest rates have been pretty similar between the US and the euro area. And that's but when there is more divergence, put it like that, I mean, it becomes visible that the role of the euro in international debt markets moves with the interest rate differential. And that's, let's see where we end up in terms of any interest rate gaps between the dollar system and the euro system. But that's a pretty basic driver of the international role of the euro, at least at the business cycle level. But I'm not going to, I do think this kind of European-driven agenda about the international role of the euro, we also need to take that kind of global perspective. How does it all fit together? But let me come back to what I said at the start. Having hedging opportunities between the euro and the dollar especially does make for interesting issues. And again, another kind of research literature in recent years have been looking at kind of the pressure on that. Some people call it, the liquidity premium, convenience yield. Thinking about what drives, when the same company can borrow dollars, can borrow euros, and so on, and what drives that convenience yield differential, I think is interesting. Maybe I'm going to go back to this idea that, of course, no one's designing a global system here. And so you do have to think about what are the spillovers, what are the implications of incremental development of the international world of the euro, and how that might fit in with incremental development of the RMB as a regional currency and so on.
Right, thank you, Phil. Richard, do you want to also address the question of what the sanctions on Russia are doing to the international monetary system in the short and longer run?
As you can imagine, a slightly sensitive question for us. I mean, I think what's interesting, I mean, clearly we're talking about an unjustifiable and illegal war perpetrated by Russia. And sanctions, of course, are better than the alternative in terms of the response to that illegal action. That's clear. I think from our point of view, it's pretty interesting that developing countries who have come out strongly to condemn the war and the actions of Russia have almost all of them have not followed the sanctions route. They've resisted going to sanctions, and some have come out very strongly against that. I guess on two grounds, probably. One is that they don't really work in terms of, I mean, you know, the work that everyone's now reading by Nick Mulder on the history of sanctions going back to the League of Nations, I think is, is an important contribution here. But of course, I think probably more importantly, because you know, they tend to be the third parties that are hit by that. I mean, we will show in a report that we will launch on Thursday that, you know, the growth will be hit significantly in some parts of the developing world this year, not all, but some. And in the context of what we see as countries that are already under stress coming out of the COVID-19 shock, then that could tip some of them over, and some of that obviously is due to the tightening by the Fed and other central banks, but some of it is clearly due to the consequences of sanctions. And those sanctions will probably have a long-term or medium-term impact on some countries. There's a growing concern, I know, in parts of the developing world about lack of access to fertilizers and the consequences that will have for the next crop cycle in parts of the developing world, and countries that are already facing problems with hunger are particularly worried about that, because you know Russia and the Ukraine are significant producers. So I mean these are the consequences I think that we look at. I'm not sure that the multilateral system is hardwired to really deal with these kinds of problems, clearly it should be, because again it's the point that the people who are least responsible for this problem are likely to be hit the hardest. And it should be the job of the multilateral system to deal with those kinds of problems. And it clearly is not. So that's, it's not a Bretton Woods moment. I don't think it, even though I've written a book arguing that it is, it's probably not a Bretton Woods moment, but I mean, these are growing concerns, at least for large parts of the developing world, that they feel a system, has not really been designed to deal with their problems and continues to fail to deal with the problems that they face.
Thank you, Richard. I have also called for a Bretton Woods moment more than once in my recollection, but I guess you are right. It's not a Bretton Woods moment now, and it hasn't been for the last 50 years, obviously. One last question for myself that I wanted to ask to Claudio, because the BIS has been so active in the whole area of fintech on digital currencies. So one of the discussions that emerged is now that we know that sanctions can happen on central banks and reserves can be frozen, will this lead to an acceleration of fintech solutions to currencies? We don't seem to see it yet, but what is your...
You're thinking of in order to avoid sanctions? Or what do you say?
As alternative currencies. We're still talking about, how this could influence the international monetary system.
Yeah, well, I don't think that but I also would like to hear, what Philip Lade thinks about this. But I don't think that the sanctions in and of themselves would have a big impact on sort of cryptos, sort of developing cryptos a lot, in the sense that it's easy to get into cryptos, but it's not easy to get out of them. And at some point or other, you would need national currencies, particularly the dollar, if you want to get what you want as an ultimate settlement medium. But of course, there is a huge impetus globally to try to develop better digital solutions to this digital world. It all started, as you know, with global stablecoins, which ended up actually getting the governments and central banks to step up at the plate, and do much more work. There is a huge amount of work going on with respect to cross-border payments. There is a huge amount of work going on with respect to CBDCs, and in particular cross-border international CBDCs. A lot of that work is actually, quite a bit of that work is also being supported at the BIS, not just by the committees, but this new latest kid on the block, which is the Innovation Hub, where practical pilot type solutions are being developed together with the central banks. I think that those are the main factors that will be driving fintech solutions, and in particular, the use of crypto assets as quasi-cryptocurrencies as means of exchange. And the view that we take at the BIS is that at the end of the day, there is no better solution than having a system which is up to the new digital world, but with central banks at the core as the source of trust. You have to earn the trust. It's not as given, but it's it's definitely the best of all possible solutions within an open system that can leverage innovation.
So Phil, did you want to? Now we are actually running into time. I thought we have so much time. In fact,
let me just briefly. I think what we've learned from recent years is disaster risk is not so rare. And when we have disaster risk, there's a very big incentive for the private sector to have safe assets in kind of international currencies. And in turn, if you want to maintain demand for your local currency, it has to be clear to everyone that holding the local currency is safe because the central bank holds enough reserves, so that if there is a scramble to convert, the central bank, has reserves available. So I'm not so sure, because as Claudio just said, which is privately you might be tempted into crypto, but when you say, okay, when you come to a difficult situation, can you really convert from crypto to something you need to transact? So I would say more it kind of reinforces the importance of safe assets. And there's a second issue, which of course is very important, is making international payments easier, which is where the digital options can help. But of course, we have to tread carefully a little bit, because there's a whole literature now about the easier we make currency substitution, it can also be maybe paradoxically self-defeating, because it can create the more opportunity for running, which is not a concern for the advanced economies, but for the stability of a developing or emerging market economy. This we need to be careful about this. So again, it's really tricky territory to be on.
All right, thank you very much to all of you. This has been fascinating. I was, as I said, I thought we have a lot of time, but it was a very, fluid and interesting conversation. I had watched again the first of the sessions that was recorded and is super interesting. Well, the others too, but that in particular I just watched again because it looked at the history of what happened at the time. And you know, we had several discussions. There were several discussions about when did it actually collapse, the Bretton Woods, what happened at the time. Well, we have one person here in this room, Zoom room, Alexander Swoboda, who was actually there. So Alexander, you can give your maybe some memories and definitely the last word.
Well, how much time do I have?
You have now, so I went over, you have 5 minutes left. Is that fine?
Okay. Well, I don't have that many memories, but I just looked up the title of my thesis, which was finished in 1966 at Tille, and it was called Outer Currencies, Capital Mobility, and the Euro-Dollar Market. And if I mention that, it's just that there were lots of things going on before 1971, which we sort of forget that 1971 was not an abrupt change but it was something that was there for some time. And what I'd just like to say, when I looked at the program of those 4 seminars, let me just go very quickly over some of the questions that were asked by the organizers. And it was the first one, and that's memories. What happened, when, and why? I think it's quite important to remember that what happened on August 15 was a formalization, basically, of the dollar standard. It was the end of the gold exchange standard, which in fact had been operating since the 60s as a dollar standard. Now, so in fact, the gold exchange standard that was ended was already a particular form of the dollar standard with the disciplining element on the United States, if you wish, of having the conversion of gold into dollars. Now, why did it? When did it break down? I think in our discussions, Catherine Schenk told us there are many different dates at which you can date it from, and if you really want to look at it, 71 August 15 is a good symbol. Why did it end up? For a number of reasons, proximate causes, long-term causes, and here we get back to this last session. I would very much agree with some of the statements Claudio made, and also Pierre-Olivier. Basically, it was not the Triffin dilemma. However much I cherish Bob Triffin as one of my teachers, I think the reason it broke down was not because it was deflationary, but because indeed it was inflationary, if anything, and other countries wouldn't adapt to it. Let me briefly comment on the second question that was asked. What problems did the move to floating rates solve? What have we learned on the pros and cons of policy regimes? Here, I just want to say that floating exchange rates were adopted very reluctantly at the time, sometimes by choice, sometimes by default. And it was only by 1967 that the move to flexible exchange, 77, that the move to flexible exchange rates was agreed on or formalized in the Jamaica agreement at the IMF. Now, the hope was independence of monetary policy and isolation from shocks. Now, independence of monetary policy we got, isolation from the shocks we didn't get for somewhat obvious reasons with hindsight, endogenous capital movements and channels of transition that go beyond those operating through the trade balance or the capital account. Now, how has the end of Bretton Woods influenced economic research? I'm not going to go into that at this stage. I think we got a long list from Maury Opsfeld and a very good discussion also of what had not been done by Ricardo Reis, and I would totally agree with them. But I think also one of the things was that research started also a bit more on the role of currency denomination of transactions of vehicle currencies and more generally on the nature of money, which brings us to this today's last question. Now, last session, since it's fresh, I don't want to try and remember it, but what I want to say is that there is a continuity and there are breaks and there are new things. What deeply worries me today with the war, in particular in Ukraine, and its implications is maybe globalization was already breaking down, but it was breaking down in a fashion which was relatively manageable in the sense that people were starting to think about supply chains, how to repatriate some of the stuff, and so on and so forth. I'm afraid that this is also a breakdown of multilateralism, or that it may bring a breakdown of multilateralism, however weak it may have been before, and that it might be a reverse Bretton Woods moment rather than a Bretton Woods moment. I do sincerely hope it's not that. I also want to thank you, the panelists today, you, Beatrice, all the panelists for the last sessions, the people who organized it. I want to mention Hannah Soisson, who was technically behind all our sessions. And that's it. Thank you.
Thank you. Bye-bye, everybody. Have a nice evening or day, depending on where you are.
Bye-bye.
Thank you. Bye-bye.